All right. Hi, everyone. Ryan O'Donnell here. And I just wanted to send you all a quick note in response to some of the recent market volatility that we're seeing. Behind me here, you'll notice I have Porky the Pig. My nickname is Pork Chop. And if you've been to my office, this pig is displayed prominently in my office. So what are our thoughts on all this volatility here, and what should we do? Well, not surprisingly to many of you, our response is we're going to stay disciplined in the face of the coronavirus and in the face of really any crises that comes our way. I want to share with you just some stuff to sort of back up why we do this and why we don't react to information like this. So can I get this here? Hold on. Okay. So when dealing with any kind of crisis, right, when something strange happens in the market, and it's strange because the market has been going up for several years now and at a very good rate. Things appear to be, doing very well. But, take last week, for example, the markets dropped 10, 12% in a week. One of the biggest drops since 2008. So it's enough to open your eyes and say, what's happening here? I don't want to live through 2008 again, 2009. That was painful for a lot of people. But it's also important to remember what makes the most sense. What should we do as investors when dealing with these types of crises, if you will? And so this slide here sort of represents what happens if you're sitting in traffic and the stress that kind of comes along with when you get out of one lane, you do something different, and then all of a sudden the other lane's going forward. And then you get back, and then the other lane's going forward. And this creates stress and anxiety. And to me, this is why if you have an investment plan, an investment philosophy that you can believe in, that's transparent, you're going to have a great outcome emotionally and financially as well, because you're not going to be swayed to get in and out of different lanes. Okay. I put this stock price in there because people ask me, should I get out of the market and just get back in when things get better? Well, yeah, the answer to that is sure. If you know when those two things are, if you know you can get out today and you know when the right time to get back in, by all means do that. But there's been no historical or reliable way to do that, and no one's proven to be able to do that successfully over time. So I think that's a very, very hard thing to do, because even if you time things right one way, you have to time it right getting back in. Here's a great example of a stock chart. This is the price of Heinz Ketchup, Heinz Corporation, prior to the announcement coming out that Berkshire Hathaway was buying them. This stock jump, this 20% increase in value, happened instantaneously. By the time you read about this in the paper or heard about it on CNBC, the stock had already jumped 20%. You can see what happens over the next 2, 3, 4 months. The price flatlines. This is the market reacting to new information. Here's the volume of the stock, the number of shares traded, correspond directly to the information coming out. Markets react quickly to all available information. So where does that leave us with the coronavirus? The markets, are they overreacting? I don't know. I think they're doing their job, though, at reacting to the information available and setting prices accordingly. The coronavirus and what's happened so far, yes, is going to have an impact. What's the lasting impact going to be? I don't know. But I do know that the markets are reacting to that information and doing their jobs. So this slide right here, and I referenced this in my email, looks at what happens if you stay the course through some of these crises going back 40 years. Let's look at, were you rewarded as an investor going back to the 87 stock market crash? A year later, you were up 19%. 76 years later, after the crisis started, you were up 76%. I can go on the savings and loan crisis 5 years later, up 61%. The dot-com crash, you were up 50% 5 years later. The terrorist attack of 9/11, the Lehman Brothers bankruptcy, the US debt downgrade. There are a number of examples throughout history that show how resilient the markets are and how staying disciplined, staying the course is your best option. Here's a great slide right here, just showing here the market's dropping 10% or more from previous highs. Sometimes it's painful. And if we go back to where the Lehman Brothers went bankrupt right here, 51% negative over a 16-month period. That was a very deep and painful stock market collapse. If you stayed the course, the next 115 months, you're up 385%. I can go on and on. The dot-com crash here, the subsequent months, 108%. Here's the Great Depression, right? The markets react very quickly, and the markets do what they're supposed to do. I don't know how long this coronavirus volatility is going to last and what the long-standing implications are. But I do know that we have an investment approach that is diversified, not only in terms of number of securities, but geographically as well. So we're not just, we're not subject to any one country getting adversely hit. We're diversified across 44 different countries. We own over 12,000 individual stocks. We have a very diversified portfolio, and we want to stay the course. If we look back at 20% downturns going back to 1926, there's only a handful of these, and they are sharp. They scary, sure. I certainly empathize with that. But the reward coming out of that is so huge that, to me, it's not worth trying to guess what's going to happen next or predict the future. We don't need to do that in order to have a good investment experience. Let's go back 50 years and look back from 1970. And all the major headlines, all the major negative headlines that came out in that 50-year period, if you knew those in advance, you would not have invested. There's no way. Let me just read some of these to you. The Arab oil embargo, the S&P 500 down 43%, inflation at 13.5%, Dow drops 23% on Black Monday. We have the savings and loan crisis. We have the dot-com crash. We have the 9/11 terrorist attacks. We've had 2 Iraq wars. We had the subprime mortgage crisis, which led to the Lehman Brothers bankruptcy. On and on these headlines go. There will always be a crisis that comes to us and affects stock prices in a negative way. But history has shown us that we will be much better off if we stay the course. In fact, going back 50 years, if you had started with $1 million in 1970, you would have over $54 million today. Again, I know it's scary to read the headlines and see our portfolio values go down, but I can tell you that we are doing what's right for your portfolio. If you have any questions, by all means, reach out to us, give us a call. We'd love to sit down and talk with you. I don't know what's in store for the markets, but I do know that we're doing exactly what we should be doing in response to this. I'm Ryan O'Donnell, and thanks for watching.